Hi, and welcome to Chapter 13, Leverage in Capital Structure. So in today's chapter, our learning goals are going to be to discuss leverage in the capital structure, how the break-even analysis helps us to determine the risks of a company in calculating the operating break-even point, and the effects of change on the break-even point. We're going to look at understanding operational, financial, and total leverage, and the relationship among those three leveraging factors. We're going to describe the types of capital, external assessment of capital structure, the capital structure of non-U.S. firms, and the capital structure theory. We're also going to talk about optimal capital structure, how to obtain it, look at some graphs and charts and some valuation models. We're going to talk about the EBITDA to earnings per share approach for capital structure. And we're going to review the risks and returns of alternate capital structures and linking them to the market value of the stock. Okay, so first let's talk about leverage. What is leverage? Well, think of a lever. And a lever is something that gives you additional power, if you think of a traditional lever. But leverage in a business is the effect that fixed costs have on the returns of what the shareholders earn. So the higher leverage generally results in higher but more volatile returns. So leverage basically refers to borrowing money to buy fixed costs to run a business. So fixed costs, they don't rise and fall with the change of production. So think of the rent on a store, monthly insurance, things that are going to be a fixed cost no matter the size of the operation. Now, fixed costs do have to be paid whether the business is selling products or not selling products, so just a continuous cost. So leverage can magnify returns and risks. And the risk is not being able to pay back the leveraged money, and the additional returns is being able to expand and being able to have a bigger business. So capital structure is a mix of long-term and equity maintained by the firm. So the firm has multiple sources, as we learned in Chapter 9, to fund their capital pool of the company. So operating leverage is concerned with the relationship between sales and earnings before interest and tax, or what we call operating profits. So financial leverage is concerned with the relationship between the operating profits, the EBIT, and the EPS, the earnings per share. And total leverage is the combined effect of operating and financial leverage together. So looking at the full spectrum from sales to earnings per share. So this would be the total leverage would be from revenues to earnings per share, and we can break that up into operating and financial leverage within the total leverage group. Now the break-even analysis is an important one where we look at the amount of products we need to sell to break even. So it's looking to put a number on the level of operations necessary to cover all the costs and evaluate the profitability of various levels of sales. Sometimes also called the cost volume profit analysis. So the break-even point is at which the sales, it gives us the sales necessary to cover all the operating costs, which is EBIT. So the first step in finding the operating break-even point is to divide the cost of goods sold and operating expenses into fixed and variable costs. Fixed costs, as we know, are going to be paid in a given period regardless of the amount of products you sell, and variable costs will be tied directly to the sales volume. And that could be the direct material and labor to make each product. So you can see how if you make more products, you incur more variable costs. Okay. So if we're doing the operating leverage cost and break-even analysis, we can assign these characters or variables to represent the different levels of the income statement. So the sales revenue is going to be P times Q, which is price times quantity, less the fixed cost, which is represented by FC, and less the variable cost, which we calculate by variable costs per unit times units. And then if we take the P times Q minus the fixed costs minus the variable costs, we get the EBIT, or operating profits. So now, if we want to rearrange this formula, we can rewrite it to solve for the quantity. So if we put fixed costs on top and we divide by price minus variable cost, we'll get the quantity at 0 break-even point. So this will tell us the amount of quantity we need to break even as a company, or the minimum amount we need to sell to not lose any money. So in this one scenario, if we have $2,500 in fixed costs, price of $10 per share, and $5 variable cost, then we wind up needing to sell 500 units to reach the break-even point. In this chart, we could see that same formula here. We can kind of display the results here. So here we have the $2,500 fixed cost. Here are the 500 units in sales, and we can see that it creates the break-even point. So if we just go back up here, 500 units. Here is the fixed cost, variable cost. So with 500 units. So now 500 units is going to bring us to our break-even point. So now, say we go to 1,000 units, if we sell 1,000 units, our operating costs will increase, but so will our sales revenue. And you can see how with leverage, the distance between operating costs and sales revenue starts to spread apart, meaning this is the earnings in between. The EBIT operating profits are in between. So down here there's 0. We break even. As we escalate sales revenue by escalating units, we start increasing our EBITs, and this widening of costs to sales is showing leverage or increased earnings as we increase our sales. So that would be a graphical break-even analysis. So what's the effect if we increase in variables? So if fixed costs increase, then the break-even point will increase. And we don't want the break-even point to increase because it means we have to sell more units to break even. If the sales price increases, that's going to decrease the amount of products we need to sell to break even. And if the variable costs increase, that means we're going to increase the break-even point. Now the inverse is true. If we were decreasing these variables, then it would be a decrease, increase, decrease, as noted here. Okay, so let's do a breakdown on the leverage analysis. So let's look at Cheryl's posters, which is to elevate the impact of several options. One, increasing fixed operating cost to 3,000. Well, if they increase the fixed cost to 3,000, then they have to sell 600 units at a price of 10 and a variable cost of 5. What if they increase the sales price to 12.50? Well, if the fixed costs stay the same, they increase the sales price, then we have 333 units for the break-even point. And 3, what if they increase their variable cost per unit? So if they increase the variable cost per unit from 5 to 750, now we need to sell 1,000 units. And 4, simultaneously implementing all 3 of these changes: increased fixed costs, increased sales price, increased variable cost. And we wind up getting back to the 600 unit level. So that's just a quick what-if analysis on different scenarios. Okay, so you could also do this in a break-even analysis in personal finance. If you're looking at this guy Rick here is considering having a new fuel-saving device installed in his car. Such things do exist, but manufacturers warn against installing them. Okay, so the installing cost of this device is $240 paid up front, a monthly fee for $15. He can terminate the use of the device at any time without penalty. So he estimates the device will reduce his average monthly gas consumption by 20%, which, assuming no change in his monthly mileage, we can translate to the savings about $28 per month. So he's planning to keep the car for 2 more years, in which is determined whether he should have the device installed. Okay, so if we take the fixed cost of the device and we divide by the $28 a month in his savings per month minus the monthly fee, we get the fixed cost of $240 divided by 13, which would be 18.5 months. And since he's going to have the car for 2 years, which is 24 months, the break-even point would come in 18.5 months, so it would be a yes to doing this. Okay. Now let's look at operating leverage. So operating leverage, used to fix operating costs to magnify the effects and changes on sales and the firm's EBIT, or earnings before interest and tax. So we can go back to Cheryl's posters. We know that the price of her poster is $10 per unit. The variable cost is $5 per unit, and the fixed operating cost is $2,500. So let's look at, if we put this in a chart, we could say that we have two quantities, quantity 1 and quantity 2. What if she sells 1,000 posters? So if she sells 1,000 posters, we make enough to surpass the fixed costs, we make enough to surpass the variable costs, uh, or the break-even point at 500. So then we wound up getting a total operating costs of um, this amount, which is 7,800 or so, I'm not sure. And then we wind up having a sales revenue of 10,000, so EBIT of 2,500. But if she moves to selling 15,000 posters, fixed costs don't change. So because the fixed costs aren't going to be any difference from 1,000 to 1,500, the leverage, because of the leveraging effect, now the costs, they do go up, but not as much as the sales. So the sales actually go up to about 15,000, and she winds up netting EBIT of 5,000. So doubling our EBIT when she increases sales by 50%. So 100% increase in EBIT and a 50% increase in quantity. So that denotes that there's operating leverage. As long as there's if there's a different change in increase in earnings to the increase in costs, there's operating leverage. Okay, so to look at it on more of a numbered scale here, we could see that case 1, she goes to 1,000 to 500 posters. Case 2, she goes from 1,000 to 1,500 posters. So we can see this is the 50% increase in posters. This 50% increase in posters generates a 100% increase in EBIT. Now, if she goes to selling 500 posters, a 50% decrease, we wind up making no earnings, so this becomes a 100% decrease. Okay, so how do you calculate the degree of operating leverage? Well, it's a numerical measure of the firm's operating leverage. So we can look at the percentage change in EBIT divided by the percentage change in sales. So we know that the percentage change in EBIT was 100% and the percentage change in sales was 50%. So that would denote a degree of operating leverage of 2. And as long as the DOL is greater than 1, there's operating leverage. So in both cases, if we go up to 1,500 posters, it's an operating leverage of 2. If we go down to 500 posters, it's an operating leverage of 2 for Cheryl's posters. Now, this can also be done using a more direct formula to calculate using some of those variables we were working with before. So we know that Q is quantity, P is price, VC is variable costs, FC is fixed costs. So taking Cheryl's information on her poster company, we can do 1,000 posters times sale price minus variable divided by 1,000 posters times sales price minus variables minus fixed cost, and we get the 5,000 over 2,500, and that's the 2. So you could calculate it either way using these variables or the percentage change. There's two different ways of calculating operating leverage. So if you look in the book, there's a vignette on Adobe leverage. So Adobe Systems makes software. You might be familiar with PDF files. They're the creator of that format, and Adobe Acrobat is one of their programs, as well as many other programs, including I think Dreamweaver, maybe Premiere for editing movies, and Illustrator for illustrating pictures. So it's a pretty big company as far as their products. So they're the second largest PC software company in the United States, dominating graphic design, imaging, dynamic media, and tool software markets, authoring tool software markets. Okay, so as demonstrated in the following table, the operating leverage magnified by the increase in EBIT's 2007, 2010, 2012, while magnifying the decrease in earnings EBIT in 2009. So 22% increase in 2007 sales resulted in a growth of 39%, but in 2009 the revenues plummeted 17%, an effect of leveraging EBIT declined even faster at 35, posting a 35% drop. Well, okay, so let's move on to the chart. This is basically just kind of showing their leverage, so we could see their sales for each of the years and the EBIT for each of the years, and then we could calculate the percentage of change in sales from year to year. So we can see in 2009 sales actually decreased by 17%, and then we can see the percent change in EBIT. So we can see that the degree of operating leverage was the highest when the sales decreased, and that could be because fixed costs aren't changing, and a decrease is going to exacerbate the leverage more than the increases. Um, and this particular for this particular company for how their earnings EBIT worked, and we don't know specifically what their fixed to variable costs are, so they both play a factor in calculating this. But this is something that we would want to take a real company and apply this degree of operating leverage. So the higher the number, the more operating leverage they have. So it's interesting as they move forward in time, they start making more sales. If you making more sales and making more EBIT, however, the percent change in sales to the percent change in EBIT, you see that there isn't as big of a spread between. So when there's a big spread between, say, 22 and 39, and a smaller spread such as 11 and 10, it's actually going the wrong. It's a smaller spread. Even 13 to 15, we have a lower percentage. Okay, so just basic math there. So we'll go back to Cheryl's posters here. So if the is pretty much the same here. Degree of operating leverage is again, now what if this is a scenario here, the reduction in variable costs from 5 to 450, an increase in fixed costs from 25 to 3,000. So this is sort of what if scenario. So what if this does change? Well, again, we put the numbers in, we're just changing the variable and the fixed costs, and we get a lower leverage here due to actually a higher leverage here, 2.2, because now EBIT is going up to 550, but the EBIT is still 2,500. So we have even higher leverage. So what we can say is, variable costs and fixed costs, depending on their amounts, are going to change the percentage of leverage. So if we look at this case again, a 50% increase, a 50% decrease, we're looking at operating costs here. So if we get a 50% decrease in our posters from 1,000 to 500, our EBIT goes from 2,500 to negative 250, which is a 110% decline. And if we increase our posters by 500, we get a $5,250 increase, or 110%. All right. Just looking at these numbers here a little bit. Okay, so this would be the degree, the percentage degree of operating leverage. Right, so let's move into financial leverage. Okay, so financial leverage. So we're looking at the fixed costs and how they're magnified by changes in earnings before interest and tax to earnings per share. So we're looking at the other side of the income statement. So the two most common fixed financial costs are interest on the debt and preferred stock dividends. So we'll look at this Chen Foods as an example. They expect an EBIT of $10,000 the current year, and it has $20,000 bond at 10% annual coupon, and a rate of interest and 600 shares of preferred stock at a $4 dividend. Now, it also has 10,000 shares of common stock outstanding. The annual interest on the bond is $2,000, and the annual dividends in the preferred stock are $2,400. Okay, so let's look at a change. So we're starting at this $10,000 in EBIT. What happens if we go up 40% and we go down 40%? So if we go down 40%, the net effect is earnings per share of 0. And if we have just a $10,000 EBIT, then we have our earnings per share of 240. And we have, because we have 1,000, these represents the shares outstanding. And if we go up 40% to 14,000, we're going to have a earnings per share of earnings available to common shareholders of 4,800 divided by 1,000 shares, give us an earnings per share of 1480. So we can see that we're going from $2.40 to 1480 is a 100% increase. And going to 0 is a 100% decrease in their financial leverage. So we could use the percentage change in EPS divided by the percentage change in EBIT. So what is the percentage change in earnings per share? Earnings per share went up 100% here. And if we look at EBIT, that went up 40%. So it would be 100% divided by 40%. So 100% divided by 40% shows us a financial leverage in either direction, increasing earnings EBIT or decreasing EBIT, and we get a 2.5% degree of financial leverage. Now we can also calculate this using other variables. So we could take a more direct formula. We could take the EBIT divided by EBIT minus interest times the preferred dividend. I'm sorry, minus the preferred dividend times 1 divided by 1 minus t. So in the term 1 divided by 1 minus t converts the after-tax preferred stock dividend to a before-tax amount to make it consistent with the other terms in the equation. So we just have to do a little tax conversion on the preferred stock dividend. Okay, so if we take that example, we know it's 10,000 EBIT. So we're going to divide about 10,000 EBIT minus the interest minus the converted preferred dividend after accounting for tax. So what we wind up with is 10,000 divided by 4,000, or leverage is 2.5. So there's two different ways of calculating financial leverage. Now total leverage is going to look at both operating and financial leverage together. So let's look at Cables Incorporated, a computer cable manufacturer. Expected sales of 20,000 units, a $5 per unit, at $5 per unit coming in the coming year, and it must meet the following obligations. It has a variable cost per unit of $2 and a fixed operating cost of $10,000, interest of $20,000, preferred stock dividend of $12,000. And the firm is in the 40% tax bracket and has 5,000 shares of common stock outstanding. So here's all the variables we need to calculate total leverage. So we're looking at a 50%, what if a 50% increase in sales to 30,000? Okay, so EBIT would go from 50 to 80,000, a 60% increase. And if we look at the earnings per share, it would go from 120 to 480, a 300% increase. So the degree of operating leverage is we have a 60% increase in EBIT divided by a 50% increase in sales, or 1.2. And we have a 300% increase in earnings per share divided by a 60% increase in EBIT, or a degree of financial level of 5. Now, if you take the 300% increase in earnings per share and divide it by the 50% increase in sales, we get the total leverage. We can also get the total leverage by taking the degree of operating leverage, 1.2, and multiplying it by the degree of financial leverage, 5, which will also give us 6. So the degree of total leverage, percent change in earnings per share, divided by the percent change in sales. And that would be, this is percent change in earnings per share, 300%, and this is the percent change in sales, 50%. So 300 divided by 50% is the 6%. And we can also use the variables. In some problems, it may not be able to give you all the full information you need, but it might give you variables: quantity, price, variable cost, fixed cost, and interest, and preferred dividend, and tax rate. So if we have these variables, which they gave us earlier, here's a summary of the variables from this company that they listed earlier. If we put that in that formula, we will also be able to calculate the degree of total leverage at 6. Now, like I said before, the degree of total leverage can also be calculated by taking the degree of operational leverage and multiplying by the degree of financial leverage. So in this case, the 1.2 times 5 is the degree of total leverage of 6. And just moving back here on that chart, that's where I said the 1.2 times the 5 gives us the 6. Okay, so you see there are many ways that you can calculate this degree of total leverage. Okay, if we're looking at focusing on ethics here for a second, Lehman Brothers is an investment bank, or was an investment bank before the Great Recession, and they were a major player in the subprime mortgage market. So in 2008, Lehman Brothers had $32 in debt for each dollar in equity. So they were highly leveraged, and they used off-balance sheet transactions to hide the extent of this indebtedness to its shareholders. So the transactions enabled Lehman to both reduce total liabilities and total assets, allowing the firm to report lower leverage ratios and look even safer with the start of each new quarter. So Lehman would unwind the transactions and restore the liabilities to their balance sheet. So assuming that Lehman's repo 105 transactions, as I call them, fell within the limits allowed by GAAP, then Lehman's management had that's what Lehman's management argued. But what is ethically implication of taking transactions, expressively to temporarily hide how much the firm has borrowed? Well, obviously it's unethical. They were making their company look less risky than they were, and those risks eventually um, exploded during the Great Recession as the subprime market really imploded, and thereby ending Lehman Brothers as a company. Um, okay, so let's look at the firm's capital structure and types of capital. Okay, so all the items to the right-hand side of the firm's balance sheet, excluding current liabilities, are sources of capital. So sources of capital: long-term debt, debt capital, and then stock equity, preferred stock, common stock, and retained earnings are equity capital for total capital. So allowing a following simplified balance sheet um, illustrates a basic breakdown of total capital with the two components, debt capital and equity capital. Okay, so the cost of debt is lower because it's generally the lowest cost of financing, with some limitations. So lenders demand relatively low returns because um, they take the risk that they take the least risk in any contributions to long-term capital. So lenders are basically paid back first. So since they're less risky uh, in the order of who gets paid first, they have lower rates of return demanded when they lend money to companies. So lenders have a higher priority claim against the assets. So if you're a bondholder, you go before stockholders or equity holders on the assets of the company to get paid back in case the company goes into bankruptcy. And they can exert far more legal pressure against a company to make payments than can the owners of common stock. So they have a tighter control over the company. And the tax deductibility of interest payments also lowers the debt cost to the firm substantially. So the interest on bonds is tax deductible, which helps to also make them lower costs. Now, unlike debt capital, a firm must eventually repay eventually a firm has to repay the debt, depending the bond can be 1 year, 10 years, 30 years. But equity capital remains invested in the firm indefinitely, so that you never have to pay that back. So the two basic sources of equity capital would be preferred stock and common stock, which includes common stock and retained earnings. And both of these were covered in previous chapters. And preferred stock is preferred because it pays a dividend, a guaranteed rate of a dividend. So common stock is typically the most expensive form of equity because it followed by retained earnings and then preferred stock. So preferred stock is the cheapest because it guarantees a dividend. Retained earnings is cheaper because you don't have to pay dividends on them, and then but still more expensive than preferred stock. And then the common stock equity is the most expensive. Now, so a firm borrowing very little or a great deal, it's always true that the claims of the common stockholders are riskier than the lenders because they're lower on the order of who gets paid back if there's a bankruptcy. So the cost of equity always exceeds the cost of debt. And that's why most firms prefer to borrow with debt first before they really go to capital. Now, a direct measure of the degree of indebtedness of a company would be the debit ratio, or the debt ratio. Total liabilities divided by total assets. And the higher the ratio, the greater amount of financial leverage a company is holding. So you want to measure the firm's ability to meet these payments, we can use a times interest earned ratio, which shows us their ability to cover their interest payments. So the level of debt financial leverage is acceptable between industries are different for different industries depending on how risky they are. Riskier companies aren't able to borrow as much debt compared to less risky companies which could borrow more debt. So in the industry, we could show you the average debt ratio or the median debt ratio for the industry, and then also the times interest earned ratio for each of the industries. And you can see that educational services are have a very high times interest to earn ratio compared to, say, real estate. And real estate can borrow, say, actually, finance insurance can borrow a lot more than, say, educational services. So these are between industries have different risks, so they're going to have different acceptable rates of debt and coverage. Now, non-U.S. companies have a much higher degree of indebtedness than the U.S. counterparts. So U.S. companies have typically have had an easier time going public, using equity, and incorporating equity easily into the capital structure. Foreign companies in other countries outside the U.S. typically have a more traditionally developed commercial banking system, which is set up to lend capital directly to companies and play a larger role in the corporate financing than you would have in the United States. So just a difference between the United States. Um, a larger percentage of our capital financing is equity than overseas, say Europe, a larger percentage is debt. So now let's talk about some similarities. First, the same industry patterns of capital structure tend to be found around the world. So the same patterns of industry norms are consistent around the world. Second, capital structures of the largest US-based multinational companies which have access to capital markets around the world typically resemble the capital structures of multinational companies from other countries rather than those of smaller US companies. And finally, worldwide trend is always um, is away from relying on banks for financing and towards greater reliance on security issuance, which issuing their own bonds or issuing stock. Okay, so let's look at leverage around the world. A recent study, the use of long-term debt in 42 countries found that Argentina used more long-term debt than any other country. Relative to the assets, firms in Argentina used about 60% more long-term debt than did U.S. companies. Indian firms were also heavy users of long-term debt as well. And the other end of the spectrum, companies from Italy, Greece, and Poland used very little long-term debt, and in those countries, firms paid only about 40% as much long-term debt as they did their U.S. counterparts. So there are differences around the world. Let's move over to capital structure and capital structure theory. So there are some theories that suggest there's an optimal capital structure range. So there's an optimal assortment of preferred stock, and debt to make the companies allow companies to maximize wealth. So it's not possible to provide managers a precise formula on how to do this for determining the optimal capital structure. However, it hasn't stopped finance from making theories that help offer understanding of how capital structures affect the firm's value. So in 1958, what we would commonly refer to as M&M, which is these two people that wrote a lot of papers about finance, demonstrated algebraically that assuming perfect markets, which we know there are no perfect markets, the capital structure that a firm chooses does not affect its value. So what they were arguing in their paper is that it doesn't matter what the capital structure is, it's not going to really change the value of the stock price of a company. Now, if you look at the effects of restrictive assumptions on the relationship between capital structure and the firm's value, first we have to understand what are restrictive assumptions. So, the result of the optimal capital structure based on the balance sheet, the benefits and costs of debt financing. So a major benefit of debt financing is the tax shield. So we get to lower our taxes or not pay tax on the interest payments. Now, the cost of debt financing results in the increased probability of bankruptcy caused by these debt obligations. And the agency costs of the lender constraining the firm's actions. So the costs associated with managers having, and three, the costs associated with managers having more information about the firm than investors do. So here are three, restrictive assumptions. Okay. So let's just talk about the tax benefits. We know that, okay. So let's just talk about the tax benefits. We know that the borrowing debt as a real big tax advantage. So firms who are going to be making interest payments can have those interests tax deducted. So basically, we reduce our income by the amount of interest and not have to pay tax on that, which makes us more profitable, as we saw in Chapter 9. Now, the probability of bankruptcy increases because the more debt you take on, the riskier your company becomes. The riskier it is that you will not be able to pay back your debt, and that can result in the bankruptcy of the company. Now, if we look at this example, if we talk about the software manufacturer making a capital budgeting decision, they obtain estimates of sales associated with levels of earnings before interest and tax from its forecasting group. And so there's a 25% chance that the sales will total 400,000, a 50% chance sales will be 600,000, and 25% chance that sales will be 800,000. So sort of a pessimistic, most likely, and optimistic scenarios. Pessimistic, most likely, optimistic scenarios that we talked about in the last chapter. And the data is summarized, resulting in EBIT calculations in this table. So, at each different revenue position, we wind up getting a different level of EBIT. So obviously, the most EBIT is when we sell the most when we have selling the most soda. So the probability of bankruptcy. So, okay. Now, what is the probability of bankruptcy? Well, it certainly goes up as the financial risk of the company goes up, and you're just not able to cover. Just sort of like if you went out and charged all your credit cards to the max, and you owed $1,000 of interest a month, but you only made $800 a month, you're going to go bankrupt personally. So the penalty for not meeting the financial obligation is bankruptcy, which pretty much means the company is done. So the more fixed cost financing, then the more risk in the system, the greater the financial leverage and risk. So the total risk of a firm, the business and financial risk combined, is going to determine the probability of bankruptcy. So financial risk is the risk of not being able to pay your debt, and business risk is the risk that your business is not going to make money. So together, that's going to be the total risk of a firm, business and financial risk together. Now, if you look at the current capital structure, zero debt, all common equity. So total capital and assets is 500,000. So if we put it on the scale, we can have this scale here where we say percentage of debt ratio. So right now, zero debt, if we look back here, 0 to 500, because this is in the thousands. So zero debt, 500,000 in assets financed by equity gives us, and then if we look at what our shares of outstanding stock would be, we would take column 4 divided by $20 a share to get outstanding shares. So 25 outstanding shares for this if it's all equity. If we were 60% debt, we would have 300,000, which is 60% of 500,000 in debt, and 200,000 in equity, which is the 40% of the 500,000. Now, because we have a lot more debt than equity, we're going to have fewer shares outstanding because we have 200 divided by 20. So this would just look at the effect of escalating the debt ratio to the amount of outstanding shares. And this is sort of how the capital structure would change depending on what structure we would take. 0, 100, 10%, 90%. So debt to equity. So I'm just taking minus from 100. So 10% minus 100 is 90. 20% minus 100 is 80% equity. So to calculate that. Okay. Now, if we look at the level of debt and the interest we have to pay, if we're at 10% debt level, we have 50,000 in debt of the 500,000 assets, and it's a 9% interest level. So the interest would be 4.5. If we go up to, say, 30%, now the interest goes to 10, we're going to 15. If we go to full 60%, interest is going to be higher. Why is the interest rate higher? Because it has to compensate for the additional risks, and the total interest paid is higher. So if we look at our debt percentage at 0, we wind up having earnings per share of 0, 240, and 480. So we could say the expected earnings per share is 240, standard deviation is 170, and the coefficient of variation is 71, if we want to put a little statistics in on this information. So what if we go up to 30% debt? So with 30% debt, we now have interest. So here we had no interest, and now we have interest of 15. So where does this 15 come from? This scale here. So if we go to 30%, we have $15 in interest, not percent. So $15. So that means that we wound up having instead of having a zero break even at 25 at probability, that 25% probability of those sales we mentioned earlier. Now we have earnings per share of 51 cents, negative 290, and 634. And that changes the expected EPS goes up, standard deviation goes up, and so does the coefficient of variation. Now, if the standard deviation and coefficient of variation increase from 170.71 to 242 and 0.83, that shows more variability, more risk. So even though the leverage did increase our earnings per share, so the leverage increased our earnings per share. However, why did it increase the earnings per share? Because we have less shares of stock. So when we have zero debt, we have more shares of stock. When we have less debt, see, we have 25 shares of stock here with zero debt, only 17 shares of stock with 30% debt. So even though the earnings went from 120 down to 111, we still have a higher earnings per share because we have fewer shares. But it's riskier. If we go to 60% debt, now we only have 10 shares outstanding. So even though the earnings per share 120, 111, and now 90 at the 60, because we're paying more in interest, we're paying a lot more in interest, so our earnings are going down. We have a big loss if our sales are at the lowest, $3 if our 50% percentage chance of most likely sales, and $9 earnings per share, the most optimistic sales. So that gives us expected EPS of $3.03, but a $4 standard deviation and a 1.4 coefficient of variation. Very high, very risky. When you can see that, does it pay going from 30 to 60% debt? We move from expected EPS of 291 to 303. It's only a 12% increase. For all this additional risk, is it worth it? So if we put this on a scale, we could say the earnings per share, and this is in the most likely case, earnings per share at each debt level, you can see how it increases, but here it actually increases and then decreases. So you would say this is more optimal because this is the highest earnings per share. But then we also have, this is also an increased level of risk, a standard deviation, and coefficient of variation. Okay, so if we plot this on the scale, here's a probability density. We see that the debt ratio at 0% has the highest earnings per share, or the most likely earnings per share at 240 at the 0% debt ratio. At the 60% debt ratio, we go to $3.03. But we have a smaller dispersion of likelihood. So let's go see this 240. We had a 25% chance that it would be negative 51 cents, and a 25% chance was negative 51 cents, and a 25% chance it was $6 and change. So the tighter dispersion on the zero debt. If we go up to 60% debt, yeah, the expected earnings per share is higher, but the dispersion, we could lose $4 per share all the way to make $9 per share. So there's more risk in the system with the higher debt. Now, as far as the expected earnings per share and the coefficient of variation of earnings per share, at a 50% ratio, we have a maximum earnings per share we have the highest level earnings per share at 318, which I was pointing out back here. This 318 at 50% debt. So plot that on the scale, we see that this is optimal. So 50% debt give us our most amount of maximizing earnings per share. So at a 60% debt ratio, we have the highest amount of risk. So financial risk and business risk. And at a 50%, we have a lower amount of risk. So as debt decreases, our risk decrease, because the debt is what gives us our financial risk. All right. Now let's look at the capital structure theory. So agency costs imposed by the lender. So we have to remember that managers are agents of a company. They're agents for the owners. So the owners give managers the authority to manage the firm in their best interests. Now, agency problems develop when the relationship extends not only to the relationship between owners and managers, but now the relationship between owners and lenders. So to avoid this situation, lenders impose certain monitoring um, techniques on borrowers who as a result incur agency costs. So that means that when you borrow a lot of money from a bank, they're going to want to monitor your company to better monitor their risk and their investment in you. So that's going to make an additional factor, meaning that you can't do things that are 100% in the owner's best interest, because you have to now also do things that are in the best interest of the people who lent you money. Okay, so asymmetric information. This is a situation where managers have more information about the operations and future prospects of the firm than investors do. So this could be a problem in the capital structure. Now, pecking order theory, and I think we go, okay, that's all we talk about here. So the pecking order theory is sort of putting borrowing on a hierarchy. So it begins with retained earnings, followed by debt financing, followed by issuing new equity. So this would be putting the pecking order would say that the cheapest form that we could use is the retained earnings, or the easiest form to borrow in would be retained earnings, because that's money we have from being profitable that we can spend as a company. So let's see, that'd be the first position in the pecking order. Then we'd follow by debt financing, which is a cheaper financing than equity. So equity would be the third. So we could say that the capital structure is more based on the pecking order of the managers of the company, what they prefer to do when raising equity, and that's what determines the capital structure of a company. Now, a third structure theory could be signal. So, based on the actions managers take, sends a signal to the marketplace. So, if management were to issue a lot of new stock, it would say that it's pretty positive. It's issuing a lot of stock is generally a signal that they want to share the risks with other people. So if you issue stock, then you're selling some of the ownership in the company and spreading out the risks. Now, if you do a lot of debt financing, it's generally viewed as more positive signal that management believes the stock is undervalued, and they're not going to issue new stock because they're not going to get the value for the stock, or that the chances of making money for where they're going to invest this money is so good they really don't want to spread it out on the equity side, so they're going to borrow the money, which would be the most optimal or the best effect for the company. So borrowing debt is a more positive signal than issuing equity. Sometimes issuing equity could be more of a desperate signal than for a company that's not able to raise any more debt equity. So this signaling effect can determine a company's financial capital structure. So what about an optimal capital structure? So how do we calculate an optimal capital structure? So right now there's only theories. We don't have a concrete formula that says this is how you make an optimal structure. But we can use this formula here because the value of the firm equals the present values of its cash flow. We could take the EBIT times 1 minus the tax rate divided by R to the A, which is the weighted average cost of capital. So this formula here, EBIT times 1 minus the tax rate, is really NOPAT, or not net operating profit after tax, divided by the weighted average cost of capital will give us the value of the firm. So this is a formula that is similar to the stock valuation formulas from Chapter 7. This would be like a zero growth formula, I believe. So we just modified it here to put into a capital structure. So optimal capital structure would equal whatever point V is at the highest. So the value, when NOPAT divided by the weighted average cost of capital, whatever values get us to the highest value for the company's valuation would be the optimal level, M. So at the optimal level of value, we also would have the lowest level of cost for cost of capital, the weighted average cost of capital, and the cost of debt. So if you take the cost of debt and the cost of equity, we would have the weighted average cost of capital as an average in the middle. So the optimal capital structure is the point at which the weighted average cost of capital is the lowest, would give us the highest valuation for the firm, and that's mathematically true here. So whatever is the lowest rate, because NOPAT is not going to change in this scenario. What's changing is the rate. So if the weighted average cost of capital, where it's the lowest, is going to generate the highest value for the company. Now, there's also this EBIT to earnings per share approach. So this approach looks to select a capital structure that maximizes earnings per share over the expected range of EBIT. So we can also plot the coordinates on a graph to assume specific EBIT values and calculate the earnings per share associated with them. So for such calculations for three capital structures, debt ratio of 0, debt ratio of 30, and a debt ratio of 60%, as we investigated before, this company, a soda company, presented in table 13.2, for EBIT values of 100,000 and 200,000. So let's look at those associated EPS values, how they're calculated in the graph. So here we have the three capital structures, orange, blue, and green, 30, 0, 30, and 60%. Now the earnings per share at 100,000 we get 240, 291, and 303, and at 200,000 we get 480, 634, and 903. So if we plot that on a chart, we have a break-even point right here where at 50 earnings EBIT, which is 50,000 because it's in the thousands, is a break-even point. Now, as we can see, we start with the orange line, the break-even point is earnings per share at 0, which would be the debt ratio at 0. Now, as we increase earnings per share, we wind up becoming, if we look in this line, the earnings per share increase, and so debt ratio at 0%, we would have earnings per share at, let's see, at this point, going from 100, so at the 100 level, this would be the 240, and at 200 level, this would be the 480. So 240 to 480. On the 30%, we see that we're going from the 291 to the 634 as measured on the scale, and on the 60% debt, we go from at the 100,000 EBIT, we go from 303 to 903. So you see this has the most amount of, has the highest slope here, which would mean the most leverage. So again, this is just looking at, this is EBIT to earnings per share and the relationship between the two variables. Okay. So when interpreting this analysis, it's important to consider the risk of each capital structure. So graphically, the risk of each capital structure can be viewed in two measures. One, the financial break-even point on the axis, which is denoted by this square. So we have a financial break-even point here at 50, and then we have it here at a lower amount, and then here at 0. And then with the degree of financial leverage reflected by the slope of the capital structure line, the higher the financial break-even point, the steeper the slope. So, and the steeper the slope of the capital structure, the greater the financial risk. So this has, the 60% level has the steepest slope. It has of the three, this is the steepest slope. So this would be the most risky compared to, these have much less slopes, the rise over the run. So that'd be just another way of looking at it. So most important to point out and recognize that when using this analysis, the technique tends to concentrate on maximizing earnings per share rather than shareholders' wealth. So the use of EPS maximizing approach generally ignores risk. And because risk premiums increase with increases in financial leverage, the maximum EPS does not ensure the owner's wealth maximization. So it's really ignoring, we're just looking at earnings per share generation here, and we're ignoring the risks to get to this $9 earnings per share. We're ignoring the risk of having so much debt. So it's just another method to look at. So if you're going to choose an optimal capital structure, we have to determine the firm's value under alternative capital structures. So how does changing the capital structure change the value of the firms and the level of return it must return to compensate owners for the risk? And we have to look at the required return associated with a given level of financial risk, and it can be estimated in a number of ways. So theoretically, the preferred approach would be to estimate a beta, and have beta represent the risk for alternative capital structures, and use the capital asset pricing model to calculate the required rate of return. More operational approach involves linking the financial risk associated with each capital structure alternatives directly to the required rate of return. So here we have the different percentages of debt in the capital structure, and we have the coefficients of earnings per share and the required rate of return. So the estimated required rate of return based on the debt ratio in relationship to the coefficient, and these would be our using the scale. This is going to become important later in the estimated returns. Okay, so we could use, here's the zero growth model. We could use the zero growth model. So we could, the value of the firms associated with alternative capital structure can be estimated using the standard valuation model. So we could use the zero growth model here, earnings per share divided by required rate of return to get the stock price. So although there's relationship exists between profits and value, there's no reason to believe that profit maximization strategies necessarily will result in wealth maximization. So what it means there is that you may maximize your earnings per share, but that doesn't always maximize someone's long-term wealth appreciation or maximization. There's a disconnect there depending on the risks. So therefore, the wealth of an owner is reflected as the estimated share value that should serve as a criteria for selecting the best capital. So that's why we want to take earnings per share in relationship to the weighted average to the required return to get the stock price. So in these cases, if we take the earnings per share and we're dividing by the estimated return, which was back from this table, so we put them in here and we can get the estimated stock price per share. So where is stock price maximized? Right here at the 30% level, we get a maximum stock price using that formula. So if we graph it, the maximum share price here at 23.28 would be preferred. So that's the maximum share value. Our maximum earnings per share is down here because we used more risk, or we had a higher required rate of return, which is going to lower the stock price. So this is the perfect representation of how maximizing shareholders' wealth, which is maximizing the share price of the stock, is different than maximizing the earnings per share based on the risks of the level of debt. So if 50% debt is riskier, which is going to lower the stock price. And at 60% debt, we get an even lower estimated share price because the cost of capital is so high. Okay, so let's look at the important factors to consider when making capital structures decisions. Well, one is the revenue stability. How stable is the revenue? So utilities that have a very stable base of repetitive revenue can have very high debt levels because the revenue is just so stable and guaranteed. Other industries, like say if you make movies, if you're a movie studio, your revenue is not as stable. And cash flow, how stable is your cash flow? Again, a utility will have much more stable cash flow than a seasonal business. If we look at contractual obligations as part of agency costs, having more contractual obligations is something you consider in your capital structure decision and management preferences. So what does the management prefer to do in signaling, and what is acceptable in their terms as far as your risk aversion, and what obligations would you have to take on by selling additional debt? So these are all other considerations in formulating your capital structure. It's not just the numbers that are going to equal the best results. Sometimes you have to also think about, how does this affect my business? Yeah, this may be the optimal earnings per share or the optimal stock price, but if I have to really have a high amount of agency costs, then it may not be worth it. Or if I have a high amount of business risk, I don't want to really put myself in an obligation to pay back a lot of interest when my revenue and cash flow is less stable. Now, also control. If managers, this is part of the agency costs. If managers have to give up a lot of control by raising capital in exchange for control of the business, then that's going to be something that you have to think about also. So sometimes issuing too much equity could lead to hostile takeovers or different control of the board or voting shares and things of that nature. So those are things the managers have to think about when they're raising capital. And also the asymmetric information about what the managers know versus what the investors know And the timing of the interest rates, when times when interest rates are low, debt financing would be more attractive than when interest rates are high. So right now we've had a low interest rate environment for a long time. So companies that actually loaded up more on their debt percentages than in the past because debt has become so affordable. Okay, so that concludes the chapter, and take some time to review the learning goals that we discussed. They're summarized at the end of the PowerPoint here, reviewing the learning goals that we just covered in this 1 hour lecture of Chapter 13. I hope you enjoyed the lecture, and see you next time.